To get the conversation started, by the time that we're recording this, it's already deep into Q4. We're already looking at the end of the year, which means it's time to start thinking about 2025. Even then, it's a time of what some have called a perma-crisis, of a lot of instability and uncertainty politically, etc. When you talk to founders, how do you advise them through these tough and uncertain times?
So as opposed to maybe a couple of years ago when we fundraise, when we invest in companies, we often are happy to look at companies that come to us with the budget for 24 and sometimes more. We advise them to take a milestone approach to hiring people, as opposed to go as fast as you can. Let's have some milestone to understand that, especially as we're sometimes fundraising people, even before they found their company. So we are trying to set real milestones to when you want to increase the burn. When do you want to cross the 100, figuratively speaking, the 100K per month, the 200K, and so on. And that, I think, is a good framework to take things slow, as today the graduation from C to A round takes a little bit more traction and takes more time, and investors are more cautious.
We also prepped a lot on how they should be much more prepared with precision around how they communicate their progress, especially to their next round of investors. So a lot of the folks that have done a Series C have to learn how to do a Series A pitch or Series A to a Series B. And in past years, you can kind of fudge it as you went along. Now, if you don't have a data room set up with all the actual metrics, all documented clearly, and all the customer references, and sometimes even contract examples ready before you go out for a growth round, you're just not going to have a very good time.
We look at investing in Southeast Asia and India. The economies are doing relatively well. Mm-hmm. Most of the economies are growing between 5 and 7%. The elections also are pretty much behind us, so the political uncertainty isn't there. So from that standpoint, there is a fair amount of optimism and positivity with the founders. The thing we try to advise them is that raising your next round is not going to be based on merely top-line growth. It's going to be based on top-line and bottom-line growth and unit economics. So don't worry about just growing the GMV. Worry about building a sustainable business if you expect to raise the next round.
So the rule of 40 comes into play much earlier than people had expected. And there's a lot of SaaS metrics that people would throw around. ACV or ARR growth was kind of the only thing that people looked at. Now it's NDR, net dollar retention, and how you can really justify positive growth there. Because if you don't have a good NDR, then people almost unilaterally just pass on the opportunity. It doesn't matter how good the ARR growth is.
Yeah. Just to challenge what all of us are saying, there's some use cases, right, where you see a company that has 1.5 design partners, and they're able to get a preemptive $30 million A round on whatever valuation. How do you explain that?
Well, it depends on. You still have the market thesis, and I think one of the things also is our companies reacting to the reality of the new buyer. So with the current, since 2021, a lot of companies have really stalled, projects around funding, marketing enablement, sales enablement, HR enablement. They're spending more resources and continue to spend money on automation and cost reduction and optimization. So what I call sort of defensive versus offensive spending, right? And our company is able to understand how to really kind of adapt their messaging to fit that and understand whether they have the same champion or need to find new champions for their products and services.
Your point about SaaS metrics, a couple of years ago, people would only look at one metric, which is booked ARR growth.
Sure.
And now founders are getting a little more used to people asking them for billed ARR, asking them about net revenue retention, asking about churn, asking about sales efficiency. And so investors are paying a lot more attention to the real health of the business as opposed to just a top-line metric.
When we're looking ahead to the next year, it sounds like this kind of planning and this kind of discipline is the antidote to uncertainty. It's the way to navigate choppy waters. Is that a fair way to put it?
I think so, because if you're a founder or if you're an investor in a startup company, you know what people are looking for. Mm-hmm. And we don't any longer need to hype the company up in the hope that somebody gets excited and someone gives an outsized valuation and writes an outsized check. we know that if you're hitting these certain metrics, then it's more than likely you can raise the round.
Yeah, and it's upon the management team's ability to understand good operating hygiene and metrics. And so in the past, we may be able to say, oh, the founders are brilliant. We could certainly hire the right COO or somebody to help and do that. But now it's like they have to actually invest in doing the work to precisely understand revenue operations and actually embody that as the CEO and not just say, oh yeah, that's something we can figure out later. So a lot of that operating hygiene is something that we look for earlier and earlier in the process, and revenue operations is actually one of the most important functions that people are starting to kind of pay attention to in growing startups.
It was particularly hard to do the transition from founders that started in 19, 20, 21, and then had to raise in 22 and a half, right? And they didn't understand how come the rules are changed. And they're smart, they know it, but it's one thing to read about it, it's one thing to understand it, it's the other thing to approach 20, 30 VCs only to get a barrage of questions that you just were not prepared. And sometimes the exercise that we're trying to do is to say, look, I might want to lead your next round. I invest in A, sometimes in B. Let me run by how I would look at it. Okay, if I was something coming from the outside, not giving you any benefit of the doubt because I know you. Okay, so that I felt helped a few times because otherwise it just seems like VCs have now become a-holes.
And then what we do more now is try to put birds of a feather together, and so let them help each other. So in these types of challenging times, what they want is a peer group they can go to, not just the VCs. And there are certain topics they still don't really feel comfortable because we're on a sort of an opposing kind of a side of the fence in some respects. Whereas with other peer founders and whatnot, so usually we'll take the ones that are like maybe a one stage ahead, and then have them come and provide. And we'll do a roundtable, and they'll lead a discussion around how they did revenue operations or how they did their Series C fundraising or their successful M&A exit. They really enjoy the other startups really like getting that peer-to-peer discussion, and there's a lot of one-on-one relationships that get built across the CEO. So we've been spending a lot of time doing that in the last 2-3 years.